Okay, good morning, ladies and gentlemen, and welcome to Macro Ace. If you joined me last night for the FMC rate decision, then you would have seen that nice surprise from the Federal Reserve, with expecting to do looking at one more 75 basis point rate hike for the next meeting, and also updating their projections for federal funds rate. But let's get into the Bank of England now. So if you're a little bit tired but you're joining us today, then great. So hello, real idiot. So I saw you last night, and hopefully you recovered well. Let's go through the Bank of England prep then. We don't have we've got about 45 minutes or so. Don't forget to share this video with your fellow traders and friends, and let them be aware, and to make them aware of it. So what is the Bank of England rate? So it's the rate that the bank pays interest to commercial banks. So think of it like the deposit rate in the ECB, where commercial banks will park their excess reserves or excess liquidity that they have at the central bank in return for amount of interest. And if the rate goes higher, that means, of course, that the bank can pay more money to those banks that have extra amount of reserve. So a high rate is better for the economy overall, in that regard, that the economy is getting stronger and is doing better enough for the Bank of England to say, okay, we can raise the rates here, and in turn one reason is to try and dampen the growth in the economy if it's seen as getting too out of hand. But the key thing that everyone is focusing on is not just growth within the economy, but inflation. Right, we're at 9.9% in the UK. We were in double digits beforehand. We had the last CPI report, but then again, so it was better, but we're still quite high up compared to the US as well, where they're way ahead in their tightening cycle compared to the Bank of England and other central banks around the world as well. Now, if we look at other points too as well, so why is it important? Well, of course, high rates, as I said, slows down growth, or was to make sure that inflation doesn't get out of hand or growth doesn't get out of hand. Low rates, of course, is to support or create growth within the economy, and also to try and boost inflation. Of course, everyone knows today the Bank of England is set to raise their rates by 50 basis points today. So not expecting anything, dramatic. A lot of it's been priced in for the Bank of England. I think the only surprise today will be looking at how the government of Japan has actually said that they have intervened in the market, which had seen the Japanese yen see a huge amount of appreciation against other currencies. So that could be a factor that plays in today, with the trading of sterling against the Japanese yen. But we'll get to that bit in a little bit here. So also, of course, raising interest rates or lowering or keeping rates at the same level affects banks handing out loans and mortgages and credits and etc. Of course, the higher the bank rate is, of course, the more consumer will have to pay for taking out a loan or repaying a mortgage. And of course, the same goes for businesses too. If they have to take out more credit, or if they need to take out credit, then they will have to pay more for that in turn. So that's what an interest rate is, and that's how it usually affects the economy. Also, way back ago, rates were back at pre-pandemic levels. And then where is the economy at the moment? Emanu says, when is the event? So the event, or the release itself, is at 7 a.m. Eastern time, which is starting earlier just so we can do some prep and get that sorted. So where is the economy at the moment? So unemployment rate 3.6% versus 3.8%. The employment change was at 40k versus 160k. Inflation, as said, was at 9.9% versus 10.1%, so it slipped from a 40-year high. UK average weekly earnings year on year was at 5.5% versus the previous of 5.1%. And 2022 Q2 GDP was in the negative and minus 0.1% versus 0.8%. GDP year-on-year prelim was at 2.9% versus a prior of 8.7%. So an obvious slowdown in economic activity within the UK economy for the second quarter data, and then also comparing it year on year as well. And then UK services PMI final. Of course, the big thing for the UK economy is that a lot of the economy is made up of providing services. We don't produce or manufacture that much that we used to back in the past. So services is going to be quite key, of course, whenever looking at how the UK economy is doing, whenever we do get those PMI figures further down the line. Also, of course, you did see the Bank of England hiking by 50 basis points to 1.75%. So this is the key. This is an interesting thing. Now, the Bank of England hasn't been as aggressive compared to of course, the Federal Reserve or the Bank of Canada, but has similarly followed the RBA and in hiking by a smaller amount compared to other nations. Now, of course, that's something to when we're considering whether or not the rate is, we're considering whether or not the Bank of England is doing a strong enough of a job to curtail inflation. But you could say that for the constraints that the UK economy has with dealing with not only Brexit, but also the energy crisis that faces Europe too, that's something that the Bank of England has to kind of weigh up and decide whether or not they go with a super strong rate hike and go for, let's say, a 75 base point hike rather than a 50 to try and curtail inflation. But they've also got to make sure that if they do raise rates by a super strong amount, that they don't curtail growth completely or have a big effect on the economy that lasts for longer than they would want it to. So that's one thing that I guess is, going to be quite key for the Bank of England in their forward guidance and also the meeting minutes we get today of the summary of the comments that they've made during their meeting that they've had. So that's going to be quite key to see what they say about where the economy is going forward. Then Emmanuel says, will the BV go to 100 base point hike? So they, I think in this case, I don't think they will. They won't go with 100. That's going to be too much. If the expectation is for a 50 base point hike, why would they jump to a 100 base point hike? The only reason why they would do that if they feel that inflation is too out of hand and they can't get it under control. But, last month, a bit of data showed that inflation did decline. It slipped from a 40-year high. So it doesn't really mean that, they need to take a really aggressive action to try and curtail that. If inflation skyrocketed, right, last month, and it was much higher than expected, then you're maybe looking at a 75 base point hike case scenario. But we haven't even seen that being mentioned by any of the Bank of England members. And we'll go through some of the comments later on. All right, so previous Bank of England statement then on August 4th. Markets imply that more BV tightening than May and show bank rates at 2.4% in the fourth quarter 2022, or by the end of this year, and 2.9% in Q4 2023 and 2.4% Q4 2024, compared to the May forecast of May being at 1.9% by the end of the year by Q4 2022, and also 2.6% in Q4 2023 and 2.2% in Q4 2024. So that's something that's going to be, of course, is going to be interesting to kind of see whether or not they update the projection to be even higher with where they expect the bank rate to be. So that if they do say that they need to, the bank rate has to be much higher than 2.4% by the end of by Q4 2022, that's something that's going to be, of course, good for the British pound when you're looking at if you're looking for a surprise from the markets to see some strengthening from sterling. But if they're more or less in line with expectation, then you wouldn't really expect too much of a market reaction. It if everything comes in line as expected with the rate and also the statement too. So also, if we're also considering, what they also said is that the inflation is to peak at 13.3% in October 2022. June forecast was slightly above 11% in October 2022. So if we're already below the Bank of England's projections before the October CPI release, it depends on what we get for the next report from the UK CPI data. But if you're saying now that the UK is kind of, the projection, the actual figure of inflation is much lower than their where they expect inflation to peak, then you could say that they're doing their job, right? They could say that their job is is working. The rate hikes are working quite well in order to bring the economy and inflation back under control. But we're yet to kind of see that at the moment. As I said, we've got to wait for the next CPI report. They also said that real household post-tax income is to fall sharply in 2022-2023, the largest two-year fall since the records began in 1964, and consumption is to fall as well. And that's expected when you raise rates. You're expecting people to borrow less and businesses to borrow less as well, which would lead to less spending on luxury goods and also in other areas too. So that's something that's expected if you're expecting a decline in those areas there. So Bank of England's Governor Bailey's press conference and other comments. So this is the interesting thing, right? So he said the UK is forecast to enter recession later this year, and pass through of BV rate rises has been faster to borrowers than to savers so far. So if we don't act now, inflation will worsen and we will have to raise rates even more. So I think with the last CPI report coming in lower than anticipated, that means that the Bank of England doesn't really have to go with mega rate hikes. So they didn't have to go with a 75 basis point hike, unless if we did see a much higher than expected inflation print, then we might have seen that as a median expectation for today, but we don't. And considering that the UK that they're forecasting a recession later this year, compared to other central banks, no other central bank has said that they're expecting a recession later this year or given a timeline for it. Right? He hasn't said how severe a recession could be. Could be a minor recession that could occur, but if they're saying that they're expecting a recession later this year, then that means with their rate hiking path, it isn't going to be as strong compared to the Federal Reserve or even the ECB at this point, right? The ECB have gone with mega rate hikes too. So that's something to consider as well with how the Bank of England has acted compared to other central banks. And if we're focusing on later on too, so if we keep going, so Bank of England member comments then. So we had a Bank of England's Pill who's saying that if quantitative tightening or QT is causing too much tightening, we can offset that with less interest rate increase. A recession remains potentially possible later this year. Goldman also, Goldman Sachs, just some other views too. Goldman Sachs called for UK calls for 22% UK inflation as plausible. They didn't really give a timeline as to when it could reach that. If they were looking by 2020 or during 2023, then that's something that could happen. But we know that as I said, if you're looking at one bit of data, looking at one decline in inflation isn't enough to say inflation has peaked. You might get a surprise that we might jump back towards the upside, like we had seen with the US CPI data. So although the year-on-year declined, all the other bits of data had seen an increase and had surprised the markets to the point where you saw the dollar see a big amount of appreciation and the stocks and the stock indices see depreciation as well. But that's what Goldman Sachs called for, saying to 22% UK inflation as plausible. The only reason being is that they probably don't have faith that the Bank of England is going to be able to do enough to curtail inflation or enough. Bank of England's Tenrero said that I will consider further rate rises until we have clear evidence of the impact on inflation. Bank of England's Man, one of the hawkish members of the very hawkish members of the Bank of England, that steady increases in bank rates has not moderated expectations sufficiently. Whether the Bank of England should raise rates by 75 basis points is an important matter. So the thought of 75 basis point is there, but only to one of the, according to one of the Bank of England members so far. So again, you'll probably get a vote where everyone would, vote in favor of a rate hike, so a 9 out of 9, okay, with the members. But then if you're looking for stronger rate hikes, you probably have Bank of England's Man being the outlier, saying that we need to do a 75 basis point rather than a 50 basis point hike. And then Tenrero being the most dovish member of the central bank could go with a 25 basis point hike instead. So again, just to make that clear, so everyone would be in favor of a vote of a rate hike. The only difference will be how much each of those members would want to raise the rates by. So I think that's going to be quite interesting to see. Well, I mean, it won't be too interesting because it might be the same or as expected if you have Bank of England's Man as the only member to go for a 75, Tenrero to look for a 25. But if all the members look for a 50 basis point hike and you've only got Bank of England's Man as the only person to look for a 75, that could add to more strength to the sterling currency, because if Tenrero is the one who's looking for a 25, says actually, yeah, I'm in favor of a 50 as well, then that could add strength to sterling as well, considering that she's the most dovish member of the Bank of England. So the key thing is that there's more of a switch towards the hawkish side rather than being so dovish that could be a surprise. Ramsden said that it's more likely than not that we will have to raise bank rate further. So obvious comment there, then that they'll need to raise interest rates and continue in their fight against inflation. If we're looking at the previous meeting then, so of course we don't have Saunders, we don't have Haskell, but here's how it was. So Cunliffe was on the dovish side with Tenrero. A lot of you had more or less from neutral, everyone looking, being slightly hawkish to very hawkish here. That was the range. So everyone looking to raise rates. Nobody is in the -1 or in the very dovish side enough to say, hey, maybe we can slow down with the rate hiking path. But that was the previous meeting. Now the next meeting, or the upcoming meeting, this is where we are at the moment. Okay, so we have Man, Haskell as the most hawkish members of the Bank of England. You can see here if I kind of compare. So this is where Bailey was, and now he's more towards the hawkish side. Not completely hawkish, but on that spectrum of saying that we need to look at more tightening. And even Cunliffe as well, going from 0 at the previous meeting, the meeting beforehand, at the previous meeting, going to the more hawkish side as well, leaving Tenrero by herself there. So that's going to be quite interesting to see whether or not Tenrero for this meeting decides to go towards the more hawkish side and goes in favor, looks to be, goes in favor of a 50 basis point hike rather than a 25 basis point hike. But again, the key thing is everyone is expected to look to vote to raise interest rates within the UK. So that's the key thing. But the breakdown is also quite important as well, how much effect you could have on sterling. Then if we're looking at public inflation attitude, so the public think inflation this year ahead will be at 4.9%, up from 4.6% in May, at the highest level in the history of the survey, which has been running for more than 2 decades. The expectation for the year after that dropped to 3.2% from 3.4% in May, which had been the highest figure recorded since 2013. And expectations for 5 years' time, or for inflation in 5 years' time, fell to 3.1% from 3.5%. This is quite key too. So if the public think that inflation is going to head down, then it could mean that their mindset is that they'll look to spend less on goods and services. But it's not always going to indicate that, because if we're looking at it realistically, first of all, we have the supply chain issues with Brexit. Okay. Second of all, we have the Russia conflict that has escalated further, with Putin adding 300,000 troops to the Ukraine conflict to try and achieve his goals in the region of Donbass. And also, on top of that, you have UK's Prime Minister Truss, who has been very vocal about wanting a tax cut and hasn't really made it clear as to where those tax cuts could be. But if it is for consumers and businesses, well, if people have more money in their pockets and inflation is already quite high, then it will just make the Bank of England's job much harder, because if you have more money to spend on goods and services, then that will lead to high inflation. So that's one thing to be aware of too. So there are 3 big factors that are going to have an effect on the UK's economy going forward, other than so you have supply chain issues with Brexit, the Russia-Ukraine conflict, and then also UK's PM Truss as well. Try not to be too political, but just try to be factual as to what it could mean for the UK economy. And then if we're looking at if we're looking at where CPI is at the moment, then if we're looking at the core bit of data, so this is quite interesting here. So core CPI data was higher than expected, and also the month-to-month core CPI month-to-month. So remember, core data excludes food and energy, right? So this is showing that there's actually healthy, there's still a pickup, there's still a demand, or a strong demand for goods and services within the UK. So that's also going to be another very key thing as to whether or not they factor in, or whether or not they say a bigger rate hike might be needed than a 50 basis point hike instead. But as said, markets are anticipating the Bank of England, to just do a 50 basis point hike, and probably be more hawkish in their rhetoric as to what they expect for inflation and the expectations for where they see the rate, where they see the Bank of England rate in the future. Just like we had seen from the Federal Reserve. Remember yesterday, the Federal Reserve updated their forecast for where they see the Fed funds rate around 4.4% from 3.4% by the end of the year, which had caused the markets to see a depreciation in stock indices and an appreciation in the dollar, although the rate came in as expected. So not only is the rate going to be quite important to see if we do get a deviation, if we do go to 75, or some people are calling in the chat, maybe there might be 100. I don't know what you guys are thinking, but already, if we do get a deviation, we're also going to be aware, very conscious of whether they do upgrade their inflation expectations and also their rate hiking path for by Q4 2022, by the end of the year, also next year and then the upcoming years as well. Now, where are we? So investment bank views and market views as well. So you had Goldman Sachs that say that small caps remain the most vulnerable to rising inflation, and strategists led by Sharon Bell wrote in a note highlighting the FTSE 100's large weighting in sectors such as consumer staples, healthcare, energy, utilities, which are much more resilient to interest rate hikes. So remember, with interest rate hikes, with the non-durable goods, right, you don't really see a dramatic rise for those goods. They're quite incremental, small rises that occur over a long period of time. So that's what Goldman Sachs is talking about, is that these the small caps, not like your large caps, not like your Tesco's or or the big brands. They're the ones that they're not really going to be able to. They're not really going to see too much of a dramatic effect. But the small cap stocks, which rely on a low rate of interest and rely on inflation not being too out of hand for them to, if they have to raise their prices, then that will kill their demand for their products or services. That's what Goldman Sachs is talking about, is that there is the fear of that for small caps, that with rising inflation, the central bank will have to raise by a big amount or continuously by a big amount to try and curtail inflation as much as they can, leading to higher prices, which could lead to a disruption within the economy if those businesses aren't able to provide those goods and services or produce those goods and services as much as they used to, if borrowing costs excel or go really, really high. You have Director of Policy, British Chambers of Commerce's Vict said that there is a limit to how much businesses can sustain rising costs. Key things are transport issues, raw material prices, energy sector regulation, and tight labor market that need to be addressed. So again, the key thing is he's talking about the supply chain issues that the UK has been facing for quite a while now, since Brexit had actually been formalized between Europe and the EU. So that's one thing. And then also the energy sector regulation, right? If you have Russia that is causing these disruptions within the energy market, causing WTI or causing Brent and oil prices to fly, with the expectation for stronger action within Ukraine, then that's going to have a wider effect on not only Europe but also the UK too. Where do they look to? Where do they go to get the energy that they need to make sure that the economy doesn't collapse, right? Or household bills don't skyrocket. So the idea of Liz Truss wanting to cut taxes is more of a short-term solution to a longer-term issue that could arise, could be created by the Russia-Ukraine conflict. Again, I try not to be too political. I hope that didn't sound political. Anyways, Morgan Stanley on September 15th, they said that they continue to expect a 50 base point hike, while fiscal stimulus, including the likely tax cut package, is yet to be announced. It could alter the Bank of England's growth projections, and headline inflation will also be about 4.5 percentage points lower at its peak than expected in August. So you have the expectation that, it's, again, depending on what Liz Truss does with tax cuts and how the Bank of England reacts, then we'll see how inflation, what the expectations are for inflation. And they also added that while the more robust firms' pricing power meant higher core, Morgan Stanley noted that headline inflation features heavily in the MPC analysis of wage demands as it impacted inflation expectations. All right, and then finally, Citi, they also said that Benjamin Nabarro, chief economist of Citi, said that the inflation data did not show signs that price growth was becoming entrenched in the economy, but he suggested that the MPC would continue to repeat its intent to act forcefully if there was evidence of a price spiral. We were in that territory for a little bit with double-digit inflation, but then inflation quarter below that, and now we're in single digits again. So I think, as I said at the very beginning, if inflation continued to be in the double digits and was much higher than 10% or 10.1%, then we would be in trouble in the UK, where the Bank of England would have to say, right, well, we've acted too late. We haven't done enough. We've probably underestimated inflation in the UK. Just like the Bank of Canada said themselves as well, before they were expected to do a 75, and they went with a 100 basis point hike as a surprise because they underestimated inflation. The same thing could have happened with the Bank of England if we were still in double-digit inflation, or if inflation was sticky, wasn't going down at all, then that's something that's going to be quite a worry for the Bank of England, and maybe it needs to do even more. even stronger rate hikes in the future. All right. So this is also one thing to be aware of too. Sentiment wise and how the UK economy is faring, regardless of, uh, regardless. That's what happens when you do the FMC. It all kicks off, and you wake up early in the morning, and then you've got a Bank of England to deal with. So regardless of where the rates are, where inflation is at the moment, just a piece that I picked up from Bloomberg article here, that UK retailers are at risk of more downside as consumer confidence plunges. And the only reason why consumer confidence will plunge is that if rates are raised substantially, if the cost of buying those goods or services is quite high or much more expensive than it used to be, then that's something that has an impact on this line chart that we currently see here. So this is one thing that, if we're comparing, so what they're comparing here is a FTSE 350, comparing it to the consumer confidence in the UK. And you can see that when consumer confidence has been high, so is the FTSE 350. But when consumer confidence starts to peel off, or at around the same time as consumer confidence starts to peel off, so does the FTSE 350 as well. So it moves more or less quite a bit in tandem with with the consumer confidence in the UK. So that's something that's quite worrying, which is what they've highlighted here, that if consumer confidence has dropped, then they're expecting the FTSE 350 to also see a significant drop as well. So we're in the danger zone. Dun, 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 dun. Yeah, Prashant Jain, don't worry, dude. Hey, got about 10 minutes. Relax. This is all part of the knowledge that you need to understand of what to kind of expect from the Bank of England. Don't worry, son. Chill. All right. So there we go. So where was I? So yeah, here we go. So they're expecting the FTSE 350 to probably see a similar direction and have a sharper downturn as well. Now, if we look at the previous release, here we go, Prashant Jain. Here we are. See, I told you we were going to get to it. just got to be a bit patient. Okay, it's about 5 seconds before the release. We'll see the bank rate coming in as expected with a 50 basis point hike. There we go, 50 basis point hike from the Bank of England. You'd seen a appreciation from sterling there as well. And if I kind of skip forward, so you see here, it kind of just whipsaws a little bit. It doesn't really hold on to it itself. It doesn't really hold on to its gain that much. So if we keep going forward, and we can see that the markets have reversed and gone in the opposite direction. So if you're saying, well, Tony, why does sterling weaken off of the back of the release if there was a hike? Well, whenever there's been a rate hike that's come in as expected, usually what's happened is that the markets have already priced that in. So when the actual release does come out, you don't really see too much reaction from the markets, as you've seen here. You've seen a bit of whipsawing on the initial candle, and then everyone everyone goes in the reverse as to what the rate was beforehand. So it's more or less buying the rumor and selling the news, right? That's how you got to treat it when markets are pricing in a rate hike. So that's how you got to see it. Unless with this rate hike that we get today, that if we get something similar to the Federal Reserve and being more hawkish in their expectation for CPI and interest rates, where they see the Bank of England rate in the future, then you'd probably see you could see some strengthening from sterling if the bank rate comes in as expected. So that's one thing. That's one scenario. One thing to be aware of. Okay, something that we'd seen yesterday could happen today as well. So just to be clear on that there. of the risk. I'm not saying that's what's going to happen, but just to be clear of that risk. So if we keep going forward, you can see that, yep, that had reversed itself. And it wasn't really it was more or less a boring release from the Bank of England. There wasn't any surprises or shocks from the Bank of England saying that they're going to do, much stronger rate hikes in the future. There wasn't any of that. So that's another reason as to why, you didn't see sterling, pop towards the upside and hold its move. Okay, so if I get out of this here, everyone's asking about what time is the Bank of England decision. It's going to be at 7 a.m. Eastern time. So in about 10 minutes time, we get the Bank of England bank rate. Okay, so that's a bit of the prep there for the Bank of England. Now the key thing is going to be looking at the deviations then for the economic release, so what we had seen beforehand. So if I just bring that up for you guys. There we go. All right. Okay. So this was yesterday's reaction, by the way, from the FOMC. Bank of England rate. Here we are. Right, here we go. So the rate hike came in as expected. Right. So this is showing the initial reaction on the first candle is what what you're looking at here. So we'd seen about 33.5 pips towards the upside on cable, and then on that same candle it was about 13.5 pips down, and after about 10 minutes of trading it was 68.3 pips down. On Euro GBP, seen about 21 pips down and 10.5 pips up. And after about 10 minutes of trading, it was 38.8 pips up. So where we'd seen the biggest reaction, though, was here on GBP CAD. Excuse me. No, we'd seen the biggest reaction here on GBP JPY. So GBP JPY has seen about 51 pips up, and then seen about 12 pips down on the initial reaction. After about 10 minutes of trading, it was down by about 90 pips. So that's one thing I think this is going to be quite interesting to consider. And also looking at the FTSE, it was down 34 ticks and up 6 ticks after about 10 minutes. Long gilts, we'd seen about 23 ticks down and 30 ticks up. And then after about 10 minutes of trading, about 64 ticks. So as said, sentiment was that markets had priced it in already. But if we do see, so here in the past, when the data has been much lower than expected, than we've seen when there was no 50 basis point hike, when traders were looking for it, then you see a very negative reaction from sterling overall, and you see more of a sustained movement in one direction from the initial candle. So if you're unfamiliar with what I'm looking at here, so the deviations that I'm showing you here is just showing you that how the currency pairs or what I'm looking at, the instruments that I'm looking at, react to the economic release, right? And how much of a deviation, and looking at the deviation and comparing to how much that deviation has affected the markets overall. So for interest rates is a bit more different, but you of course have other things to consider with interest rates. You're not just looking at figures that are going to be coming out on the website. But here we are. So I think if the same thing here, if we do get the rate hike as expected, could see a similar reaction with a bit of a pop towards the upside on sterling, which might not last too long, and then you see a move towards the downside instead. But if we get a very hawkish statement from the Bank of England where they expect the Bank of England rate to be much higher than anticipated, rather than looking at 2.4%, maybe you're looking at 3% or 3.4% for the Bank of England rate by the end of the year, then that's a lot of tightening that they have to do before the end of the year to reach that goal. And that might mean that there could be space for a 75 basis point hike in this at some point. But that could sway the markets towards strengthening in sterling instead. So we've got to be aware of the comments too. Be aware of the statement, summary of their monetary policy as well, and that could sway the markets in that way. Usually, what happens is with if you do raise interest rates, and it is much higher than expected, with a hawkish statement to supplement that too. Usually, you would see a big amount of weakening from the indexes, from stock indexes, and also the bond prices. Okay, you usually would see a movement towards the downside, and then of course the yield on that gilt would see an appreciation towards the upside there as well. So that's something to be aware of. We've got about 3 minutes now, 3 minutes left. So if you wanted to have a look at, if you're interested in looking at the deviations here that I'm showing here to you, right? So not only is it the Bank of England rate, but if you joined me yesterday for the FMC, then you've seen all this bit of data to kind of show you as to something that you can use as a way to kind of show you what to kind of expect if the figure comes in as such and such, and this is a deviation, then this could be the market reaction that you could see across a range of different assets as well. So that is something that we want to, of course, provide you with, which is completely free, right? Which you can use. You can sign up to the Macroeconomic mailing list and get that completely for free. Not only do you get the deviations for the upcoming economic releases for the week ahead, but what you also get is the expectation for the Asia session and what to look out for headline wise, or particular events that could be coming up in the European session, the US, and a summary of the weekend news as well. That's also what you get within the Macroeconomic mailing list if you were to subscribe to that. All right, so let's currently have a look here. So the median estimate is for a 50 basis point hike. All right. Okay, 1 minute to go now. Right, let me get this out of the way. Get my tick strike up and running. Let's see how this goes, huh? All right, here we go. Also, keep an eye out on what's going on with the headlines too. So I'll try and relay those headlines to you as best as I can. About 30 seconds left, or less than 30 seconds. Okay, 10 seconds. Okay, still waiting on the data. Okay, the hike, 50 basis point hike as expected. So that as expected, 50 basis point hike from the Bank of England. Here we go. So everyone voted for a rate hike as expected. We're looking at the Bank of England then and their statement. Let's click through here. So let's go through here. So Bank of England will closely monitor impact of gilt sales on market conditions. Bank of England MPC votes 5-4 to raise the bank rate to 2.25%. So doing a 50 basis point hike. So that's a bit worrying. That's was probably contributing to sterling's weakness here. Of course, the rate hike was as expected, right? But then it's a point. The point being is that there was a 5-4 vote to raise a bank rate by 50 basis points. So that's again, that's worrying there. Inflation to peak at just under 11% in October. Forecast for October was 13.3%. Bank of England MPC voted 9 out of 90 to reduce stock of government bonds by £80 billion over the next 12 months to £758 billion. Haskell, Mann, and Ramsden voted to raise the rates voted to raise the rate to 2.5%. Dhingra voted for 2%. So Dhingra was looking for a 25 basis point hike there. Haskell, Mann, and Ramsden were looking for a 75 basis point hike. So there's confusion here from the Bank of England. The key thing here, Dhingra looking for 25. That's again another thing that would present some downside movement to the market, to sterling here.